Welcome to All Things Financial with Jack Driscoll.
Welcome back, everyone, to another edition of All Things Financial. What I do with this show is try to share with everyone listening and watching on TV the information that I've accumulated over 40 years, situations I've run into with people, and I could share with you some of the mistakes I've seen made in the past to help you not repeat the same mistakes, and also repeat the good things, the successes where people have made good choices and good decisions, and we'd like to implement them into your packages too. So on today's show, what I want to share with you, I want to talk about life insurance for everybody and the 10 most common mistakes I see made with the area of life insurance. Buying life insurance is a very difficult situation to figure out whether you have enough, whether you have the right kind, etc. So the 10 most common mistakes I see when people are concerned with life insurance. The first is people relying on group life insurance. Now, when you're employed, many packages, employee benefits packages, are being cut back from larger benefits that we had in the past, and they're being cut back in many cases. So some employers offer group life insurance still for their employees. Some groups offer, or companies offer, group life insurance for the spouse of an employee. And then others offer both those coverages and an ability to purchase additional insurance up to 2 times or 3 times or maybe even 4 times the salary of the employee. Many people look at that and think that's adequate enough coverage for now. And one of the biggest mistakes we see is relying only on group insurance, because then once someone loses their job, either through no fault of their own or maybe through disability or just switching jobs, that insurance cannot move with you easily. It is a term insurance policy, what group life is. And normally, if you want to leave the company and take that insurance with you, it's not really what we call portable, and you have to convert that into a whole life policy or some sort of a permanent form of life insurance policy at standard rates, which is maybe very, very expensive, much more expensive than what your term was with the company. So relying solely on group life insurance is just simply not reliable. Another mistake I see in going with the life insurance is procrastinating. That is just us realizing we don't need life insurance now. We're single. We don't have anybody that's responsible that we're responsible for, and not realizing your plans are to get married and have children someday and have a home and have those obligations. Now, a lot of people will say, wait until you have your first child or until you get married or until you get your home to buy the life insurance. And I'm going to tell you that procrastination, even at that early level, can sometimes be a huge mistake. Number one, when you're young, life insurance is extremely inexpensive. You won't even miss it. It might only be the cost of a pizza a month for a large amount of life insurance. And buying in advance of your need has some merit. Number one, it's a life insurance policy that you have to medically qualify for. And the younger we are, the more healthy we are typically. So you might run into a situation where by the time you get the house and the cars and the spouse and the children, something happened with your health that raises the rate or precludes you from getting coverage at all. You've been diagnosed with diabetes in between that time. Your high blood pressure and cholesterol, the weight issues. You may have had something go wrong with your health, diagnosed with cancer. Even if it's curable, it can ruin your chances of obtaining really inexpensive life insurance. So procrastinating on your life insurance needs when you anticipate either current needs and you're saying, well, we can't afford it right now. Once I get this car paid off, I'll buy it. Or procrastinating because the needs haven't arisen is a second most big mistake that we see regarding life insurance. Now, a third one is once you choose to buy life insurance, buying it without shopping around or having a professional shop it for you. big mistakes, big differences in premiums between companies and even forms of insurance, many people would get a value of having a guide or a professional help through that process of shopping around many companies and many different forms of insurance. So the third big mistake we see is not shopping around enough for that insurance. Number 4, choosing the wrong type of life insurance policy. Most people are unaware there is a variation on the type of life insurance you can buy. You could buy term life insurance or permanent life insurance. Permanent life insurance can be broken down to guaranteed universal life as a common form, universal life as a separate common form, and whole life as another common form. So there's term insurance, there's permanent insurance, and those two categories are widely misunderstood. Sometimes people will say term insurance, and sometimes people will say permanent insurance and not know the difference. So that's one of the big mistakes I see in shopping for life insurance. The first thing I would say when you look at permanent insurance is that's typically for someone who says, I want insurance for as long as I live, that when I pass away, whether it's now or 40 years from now, I want at least this much coverage going to my family and my children. Remember, when we look at life insurance, we're looking at a number of different needs, and those needs evolve through your life. So you'll have a starter home, then you'll have a bigger home. You'll have your first child, you may end up with 3 children. You may end up with a lot more assets and a lot more complexibility later in life, and you need your life insurance to help protect those levels of attainment that you have. So permanent insurance comes into play there. Sometimes we look at term insurance. Term insurance you can think of as temporary insurance or rented insurance. If you want to rent an insurance policy for a certain designated period of time, whether it's 10 years, 15, or 30 years, a designated period in time. You may say, I want insurance only until the kids are out of college. I want insurance only to cover the mortgage when it's paid off. So you're buying insurance only to cover a specific need. We'll sometimes use term insurance for that. Term insurance is less expensive, typically, than permanent insurance on the initial premiums. Permanent insurance is less expensive, typically, over the long term because it has the feature, many of them, of refund of premiums through a cash value that can refund part or all of the premiums paid, sometimes even resulting in the whole insurance policy coverage ending up being free because of those refund features. So buying the wrong type of insurance can be a big mistake that we see. And we sometimes, even at age 65, see people with no insurance buying insurance at age 65 because if one of the spouses die, the pension and Social Security dies with them, and the other spouse needs a replacement of income. So think that through on the right type of life insurance, not only on buying life insurance. Now, the next area that I would say that we see mistakes is buying the wrong amount of coverage. Here's the way I see it. First, starting out, I run into a situation and it's a budget issue. Early in life, bills come flying at you. You just bought your first home, you have a baby, you got married, you have bills, your salary's not as big as it might be after a couple more pay raises or after you evolve further into your job. And so sometimes people will say, and have a life insurance agent program their needs. And their needs might result in $1 million death benefit, let's say. Remember, when we're buying life insurance, and when you're asking, how much life insurance do I need? You need to consider and write down your life goals. Here are the goals. I'd like to get all 3 of my kids in college. I'd like to pay off the mortgage. I'd like to have a retirement of this. I'd like to have retirement assets of this much. So you're contributing to your Social Security. You're contributing to your 401ks. It's building for your pension. You're paying down the mortgage, and you're building up a college savings account. All of those things, machinery's in place. Now, here's where life insurance comes in. any one of you who follows sports, football or hockey, is familiar with the term next man up. No matter who goes down for injury, it's next man up. We don't cry, we don't complain. It's next man up, and they have to fill the shoes of the one that went down. In our individual lives, there's no next man up. If the breadwinner gets disabled and both spouses are working, either one of the spouses gets disabled or dies prematurely, there's no next man up. We use life insurance in that case and disability insurance in that case to replace that person and be a self-completing asset to self-complete all the goals that individual did not have the ability to complete. So we're buying life insurance in this case, and we want to know what's the amount of life insurance to self-complete all your goals. If we run into a situation and we say it's $1 million price tag to complete all your goals, or a $2 million price tag, early in your life, we might say you need permanent life insurance to match, and yet can't afford it. Do not make the mistake of the wrong type of coverage, buying $100,000 coverage of permanent insurance because that's all you can afford right now, when the same premium might have bought you $1 million of term coverage. Knowing you're going to replace term with permanent later, you buy for your needs, all of your needs now, at the least expensive cost, and then you grow into better forms of insurance, rather than buying the right form of insurance now and having inadequate limits. So you buy for your immediate need, and then you evolve into the future forms of insurance. So that's another big mistake I see being made with life insurance. Now, another one is this. When we talk about beneficiaries, naming a minor as a beneficiary. Probably one of the most common mistakes I see made. We want everything typically going to our spouse 100%, and then if anything happens to both of us, we want it going equally to our children. Sounds easy enough. Every beneficiary designation will allow that, so you can list that out. The problem is this. You named, in many cases, a minor as a beneficiary. Minors can't directly inherit money. Minors can't directly control money. So anybody under the age of 18 is not of age of legal majority. They're considered a minor. And that means a guardian has to be set up on their behalf. That means the life insurance proceeds get frozen. They can't be administered properly. And there are no instructions, if you've not made those instructions in advance, with your will and with your powers of attorney and things like that, and if you've not established guardianship already for your children, and maybe even have a life insurance trust, a minor's trust, that here's what I want to happen for the life insurance. I want that it being held aside on behalf of the minor child to help support the minor child, with the guardian having authority over that and helping getting the minor child through college. So all of that, when you name a minor beneficiary as a beneficiary on the life insurance and you leave it at that, you probably just made a very big mistake, and the minors may not even get the money, even though you directed it to go that way, because legally they can't receive it individually. Huge potential problem there. Now, a next area that I see is this: naming or defaulting the estate as the beneficiary. A lot of people, when we do life insurance, say, well, I don't know, why can't I just name the estate? Or I might have a single person saying, I don't know who to list. I don't know who to put down as a beneficiary. We'll ask, are there any charities or any of this? No, let's just put it to the estate of. Well, here's what happens. If you list the estate, if you name proper beneficiaries that are living at the time of your death, and they're individuals, then the life insurance proceeds transfer to those named individuals income tax free and probate free. You have avoided probate and income tax by directing and designating beneficiaries properly. The minute you say estate of your estate, immediately the proceeds now lose the benefit of avoiding probate and go directly through the whole process of probate, which is publicity, fees, attorneys, long waiting periods, and it's just a really usually horrible way to get things going through on life insurance when you could just directly name the beneficiary. So you never want the estate typically as the beneficiary. Well, here's what also can happen. You name your spouse, you have no children, and the spouse dies. So you now have no remaining or successor beneficiaries, referred to as contingent beneficiaries, and that defaults in many cases to your estate, and you've caused exactly the same problem. Now, that's another one. And we run into it a lot, sometimes by default or accident. Another mistake, this would be mistake number 8, not doing a review on your life insurance over the years. And in fact, I implore all of you to do a life insurance policy audit, especially if you have one of the older universal life policies. What you need to do if you have one of those older policies, 10 years or more, one of the policies from the 80s, 90s, or 2000s, and it has not been reviewed, you need to get an in-force policy illustration from your existing company and evaluate, is that policy, because there are many provisions in there that are not guaranteed. The cash value accumulation rate is not guaranteed. The premiums are not guaranteed. In a universal life insurance policy, you need to review those especially and do a life insurance policy audit. We can help with that in our office if you don't have anyone you're working with now, even on your existing policies, to get an in-force policy illustration from your current insurance carrier to make sure your policies are healthy and not unhealthy and at risk of terminating or running out of money unknown to you. They may be sick, your current policies may be sick or have an illness that you don't know about and going financially bankrupt and running out of money, which we do see commonly, especially in universal life policies. Now, number 9, keeping your policy a secret. Yes, it's true. Some people have a life insurance policy that never gets claimed. You say, how could a life insurance policy never get claimed? Everybody dies sometime. Well, the reason many life insurance policies don't get claimed are they never get found. Nobody knows about them. The person who bought them, the deceased, kept the policy a secret, we would say. But it's in a drawer, and when you go in somebody's house after they pass away, there's so many papers and all mislaid everywhere. You're cleaning out the house and you're throwing out drawers and papers. You don't even realize you threw out a life insurance policy for $1 million that person had bought and paid for so many years for your benefit, and you never knew about it. At the time of death, guess what, folks? There's nobody there to inform you. You're not going to get a letter in the mail. There was a life insurance policy on that person. No one is keeping track of the obituaries. No one's keeping track, especially if the policy was paid in full and already paid up, because there won't even be premium notices. You'll just be throwing that money away. So all of you who have life insurance, don't keep your policy a secret. Have one common place where you keep all your important papers. Share that with your family members. Don't hide that, so that you're making it easier on your family members too to help care for and to make sure that everything that you wanted done after you pass away does indeed get accomplished. Don't keep life insurance policies a secret is mistake number 9. And number 10, forgetting to update beneficiary designations. Again, anyone who's had life insurance for a period of time, and I'll share this mistake expands out to many different areas. Anyone who has a 401k has beneficiary designations, pension, even if you're not claiming it yet, beneficiary designations, IRAs, annuities, all of these have beneficiary designations, not only life insurance, and your will, beneficiary designations. So what we find is after a person's done this planning, after about 10 years, those beneficiaries that were designated initially when you first got your job, when you signed up for your 401k, when you did the pension, when you did the life insurance, are not correct 10 or more years later. You have either new children or your parents were there because you weren't married yet and now your parents are deceased. Or worse, one of the parents is in a nursing home and here you have half of your estate going to a parent. They're getting government benefits and you're getting them kicked off benefits because they just inherited life insurance. So they inherited an asset. You've got to keep up with your beneficiaries, and I also ask that everyone gather all your papers together, including your will, life insurance, annuities, IRAs, 401ks, and pension, everything to get to match. Each one was purchased and put into effect at a different time of your life, and I can probably win a wager with most people that come to meet with me that all their beneficiaries on all their forms, I'd ask the question, do you want all of them to have the same beneficiaries? Most people say yes. Some people say no. My one asset, I want going one direction, and the other assets, I want everything handled the same. But most people say yes, I want all the beneficiaries to be the same. If I wagered them, then saying, I place a wager that if I review all your beneficiaries, they're not all the same, and most people will tell me, no, I'm sure they're all the same. I think I'd win the wager more, that all the beneficiaries don't match. So in most of my plans, when I work with people, those beneficiaries do not match, and those beneficiaries have not been updated. So that concludes my 10 steps, the most common mistakes I see regarding life insurance. I share with all of you, if you want to get more information on this or get free quotes from our office, we have a website set up, insurancepgh.com. You can come on the website, get free term life insurance quotes, also get information and have us help you explore more information on permanent life insurance and get you in line for a life insurance policy audit, help you with overall review of your situation, or again, a free no obligation term life insurance quote. Either way, insurancepgh.com. Thanks again, everyone, for listening and tuning in. We'll be back again next week.
You've been listening to All Things Financial with your friend with the answers to all financial matters, Jack Driscoll of Driscoll Insurance and Financial Services. Securities and investment advisory services offered through SagePoint Financial Incorporated, a registered broker-dealer and registered investment advisor and member FINRA and SIPC. Driscoll Insurance and Financial Services is not affiliated with SagePoint Financial, Inc. or registered as a broker, dealer, or investment advisor. You can reach Driscoll Insurance and Financial Services Incorporated at 412-833-1500, and they are located at 2738 South Park Road, Bethel Park, Pennsylvania, 15102.